I'm Becky Quick of CNBC and your host of The Forum. I'll be guiding you through exclusive conversations among some of the world's global leaders. Conversations previously held behind club doors, but today we invite you in. The Economic Club of New York serves as the premier forum for nonpartisan discussion dedicated to connecting the world's brightest minds with preeminent public and private sector leaders. A nonprofit 501c3, the club is a 115-year-old platform for the conversations that help shape the future of our world. The Economic Club of New York, brightest minds, critical conversations, catalyst for innovation.
Right now, there is nobody better to be speaking to than Ed Yardeni, who really has had the correct take on markets, talking about the roaring 2020s as people were talking about recession, saying that he didn't see what they were seeing. Why economists have gotten this cycle so incredibly wrong. So why? What have people been missing so much, Ed?
Well, I think expecting a recession was perfectly logical. It kind of made sense. The Federal Reserve increased the federal funds rate by 525 basis points, basically from zero, over a very short period of time from March of 2022 to basically the summer of 2023. It would make sense that that kind of dramatic tightening of monetary policy, restriction of monetary policy would cause a recession. Along the way, I concluded that maybe the Fed wasn't just tightening, but it was actually normalizing. It was bringing interest rates back up to levels that the economy had shown its ability to deal with before the great financial crisis through the great virus crisis. That was what I call the great abnormal period of ultra easy monetary policy. There's no point in debating whether that made sense or not, but the reality is that period's behind us. We're no longer in an abnormally low interest rate environment, and the economy has proven itself to be perfectly resilient in the face of the level of interest rates we have. And I think a lot of that resilience obviously has to do with the consumer. The consumer is a big part of the story. And over the past couple of years, economists have been saying that that's not going to last, that consumers had piled up a bunch of excess saving. I think there's a Federal Reserve estimate that $2 trillion was the peak excess savings. And now in March of this year, the excess savings is down to zero. So I guess any day now, we should see a pile of economic indicators suggesting that the consumer has got to retrench because they've got to save some more. But I think what that misses is the demography of our economy. We've seen the baby boomers starting to retire, and they're sitting on $76 trillion. So on one side, you have $2 trillion of excess savings that's gone to zero. On the other side, you've got a bunch of baby boomers that are retiring. Retirement is a dramatic change in one lifestyle. You're not saving out of earned income anymore. If you're lucky enough, you've saved enough so that you can live on interest and dividend income. And if you're not, then you start to go into the nest egg here. And the baby boomers are spending, and they're spending on a lot of services. And guess what? Those are the areas where employment's been very strong. So it's kind of been feeding on itself. But there's lots of other explanations for why the recession didn't happen. But I think that's the most important one.
So taking a step back, there's a lot to unpack there. I want to start with the idea of where Fed rates are now and that they've been normalized. Are rates restrictive, as Federal Reserve Chair Jay Powell says?
Well, the Fed is not restrictive if you look at the pace of economic growth, if you look at the stock market being at an all-time high here, all-time high around the world. Fed matters a great deal, not only to our financial markets, but to overseas financial markets. The dollar has been strong, so I guess that's somewhat restrictive, but it hasn't been so strong as to really restrict anybody's exports from the United States. So if you look at the inflation rate, it has come down, and I guess you can say that the inflation, that the federal funds rate is restrictive enough to bring inflation down. But look, I think what we've learned over the past couple of years is inflation is a very complex process. And a lot of what we've experienced in the past couple of years has had to do with, guess what, the pandemic. And that has to be factored into people's thinking on how the economy is performing. And it's clear, I think we all know that there were supply chain disruptions that have been ameliorated. And as a result, that's helped to bring inflation down. But a lot of economists had this notion that the only way to bring inflation down is with a recession. And so they thought the Federal Reserve would have to raise interest rates until we got a financial crisis that led to a credit crunch that led to a recession. And so far, that hasn't happened. And yet inflation's come down. I think one of the things that economists missed is China. We didn't have to have a recession because China has had a significant recession, particularly in their property market. And as a result, they've been trying to stimulate their economy by, guess what, exporting more, particularly electric vehicles and other kind of state-of-the-art green technologies. And the prices they're charging have actually been deflating. So they've been exporting deflation on the goods side to the United States. And meanwhile, we're just waiting for the service inflation rate to come down, particularly shelter. And by every indication, it should continue to come down. So I think when you put all those things together, you come to the conclusion that, well, interest rates are neutral. They're kind of where they should be. The so-called real interest rate seems to be where we are now, because in that kind of environment, you're supposed to be getting a growing economy with falling and stable low inflation, which I think we're approaching.
This really raises the issue of why are people talking about rate cuts? I know you don't think they should be. I know that you think that there is no reason to be talking about cutting rates from here, even insurance cuts or mid-cycle adjustments or any of those types of things. So what are you looking for to justify that type of move at a time where Jerome Powell seems like he's pretty committed to, at some point, as soon as they have a window of opportunity, going?
Yeah, I don't really understand that. I certainly didn't understand why the widespread view was that the markets were anticipating 6 to 7 rate cuts of 25 basis points each starting in March. That was where we started the year. And then gradually those started to become fewer and fewer rate cuts and later. And here we are with economists not talking about higher for longer. I would prefer to call it normal for longer. And so I don't have any particular reason to believe that the Fed really needs to lower interest rates. Now, of course, if you're a believer in the real rate, then you look at the Fed funds rate, subtract out the inflation rate, and say, if we don't lower the nominal federal funds rate in an environment where inflation's coming down, then we're becoming more restrictive. We've seen some Fed officials express that view. And first of all, I'd like to kind of question the idea that the Fed funds rate excluding or subtracting out the inflation rate means anything. I mean, the Fed funds rate is an overnight rate, and we're taking out a year-over-year percent change in the inflation rate. I mean, what does that mean? Who possibly acts on that kind of variable? I mean, clearly, real bond yields matter, but the Fed doesn't control real bond yields. It controls the federal funds rate. So this notion that the Fed funds rate might become too restrictive in a real sense if inflation comes down, I think we have to just kind of wing it and see how that plays out. Right now, it looks as though we've seen quite a bit of decline in inflation, and interest rates haven't come down. Look, the other thing, Lisa, is I think there's been a lot of what I call technical analysis of macroeconomic data. People look at charts and say, oh, look at that. The Fed funds rate, once it peaks, it comes down pretty quickly, and plateaus don't last very long. And I think what people don't, a lot of economists really just don't appreciate is what causes recessions. What causes recessions is the Fed tightens monetary policy to the point where something breaks. That's why the yield curve inverts, is people start buying 10-year bonds at 4%, and knowing that they could buy a 2-year at 5%. Why would they possibly do that? Well, because they figure they're not great market timers, and at some point, past 5%, the economy is going to break. Something will break in the financial system that will lead to a credit crunch. And it's credit crunches that cause recessions. The other two explanations for recessions is a spike in oil prices, which we had in 2022, but so far oil's been quite calm. And of course, bursting speculative bubbles. And we saw lots of tiny speculative bubbles burst in 2022. Stock market had a bear market. And yet here we are with the economy doing fine and without an official recession, with real GDP at all-time record high. So again, I don't understand why Powell has been signaling that he'd like to lower interest rates if in fact interest rates are where they should be empirically.
Would you like to be a part of the conversations at the Economic Club of New York? Learn more about membership, the New York City and National Fellows programs, and other opportunities for engagement in the club at www.econclubny.org.
This 5% target, I want to sit on that for a second, or not target, but this idea that if longer term rates get to 5%, something could break, but they could get to 5%, right? Without something breaking. And that if you have this curve inversion, I just want to set it up this way. I was speaking with Mike Wilson of Morgan Stanley today.
Sure.
And he explained what he got wrong this year and why he came in with the bearish view.
Yeah,
he said,
welcome to the bull camp.
well, hold on. Not exactly, maybe. I mean, maybe, but we'll see. There's a lot of asterisks there. One of them is he didn't fully, in his view, appreciate just how stimulative the fiscal policy was, as well as in some ways monetary policy, not just with respect to rates. Rate policy, he said, is restrictive, but with respect to the balance sheet and the repo lines and all of that, that really added to the liquidity profile. He said that if bond investors start to really push back on how we're financing that fiscal stimulus, that would cause equity valuations to come down significantly. Do you agree?
Well, that sounds bearish.
It was, again, a very nuanced take. Carry on.
Very nuanced. Okay, that's fine. That's fine. Look, my view on the bond yield is it's normalized. It's back to 4 to 5%. That's the kind of range we should be in. That's where we were before the great financial crisis. The anatomy of the bond yield, I just wrote about it in our publication, Quick Takes, and I said, look, it's pretty simple. It's the TIPS yield, the 10-year TIPS yield, which we have quoted in the marketplace on a daily business basis, and that's been running around 2%, and I think it'll continue to run around 2%, reflecting an economy that's resilient and growing. And the expected inflation premium that you add on top of that, I think, is where it is about now, 2.5%. That gives you 4.5%. I can widen the range and get 5% in there, but I think all that reflects a normal interest rate environment. Now, of course, some things are going to blow up along the way, maybe in downtown office buildings that have to be refinanced. That's already been happening. I think it's so important to realize that a lot of this exposure isn't just to the banks, but there's a lot of private money invested in these kind of assets. And for them, it's a haircut on our rate of return. It's not suddenly that they can't lend. I think there could be problems with some of the small banks, but we're not seeing it. I mean, the Fed really stabilized that whole situation. In the past, an inverted yield curve accurately predicted a financial crisis, a credit crunch, and a recession. This time around, the inverted yield curve is accurately predicted a financial crisis. We had that last March. On March 10th, it was a Friday. On March 12th, it was a Sunday. The Fed came in with a liquidity facility that stabilized the situation really well. Lisa, the Fed is really good at playing whack-a-mole in the credit markets. Ever since the great financial crisis and the great virus crisis, the Fed's figured out how to create liquidity facilities to keep things from blowing up. So if financial crises don't turn to credit crunches, you don't get recessions in that kind of scenario. So I think, I may be pushing my luck here, but I think the economy can live with 5%. By the way, we had 5% last October, at the end of last October, and that's because we had some really sloppy auctions. I mean, clearly, I'm not going to put lipstick on the pig of the federal deficit. But Janet Yellen, I went to Yale six years after Janet Yellen was there, and I owe her a lot because I studied from her Xerox notes and got me through Tobin's class. But Janet Yellen is very clever. And on November 1st, the Treasury announced, well, if you don't like our bonds, we're going to sell less of them in auctions, or we're going to give you more bills. Over the past year, $2.5 trillion of marketable securities have been issued by the Treasury. $1.9 trillion of that was bills. Bills are really easy to finance, and money market funds are sitting in about $500 billion worth of repos that, depending on the incentives, could easily be converted into Treasury bills. So for the here and now, I don't see a real problem with bond yields suddenly gapping up to 5% and higher and causing a calamity for the economy.
Does that mean that you think that stocks can actually continue to climb even if Treasury yields on the long end get to 5%?
Well, I think we've seen that the stock market has learned to live with high interest rates, or normal interest rates, I should say. I have to remind myself that these are normal because we're all used to such a low interest rate environment. But yes, I think the stock market is doing quite well here. I think the stock market started to discount what I've been calling a roaring 2020 scenario since the beginning of the decade. didn't look too smart there for a while with the pandemic and all the other calamities that have occurred here. But I think the stock market started to discount the roaring 2020 scenario. I know exactly when, November 30th, 2022, which is when OpenAI introduced ChatGPT, and artificial intelligence has been the rage ever since. But I'm not, I'm not of the belief that AI is the only reason why the market's up. But there's a lot of other technologies that are very user-friendly, they're cheap, and they lend themselves to increasing not just the physical power, strength of humans as previous technologies have, but most importantly, it's increasing the power of the brain. It's augmenting the brain. And so I think the potential for productivity gains is just tremendous over the rest of the decade. And I think it's productivity that's going to be the answer here. And to Mike Wilson's issue about the federal deficit, I think it is a problem. I think debt's a problem. But if we get better than expected productivity, we'll get better than expected growth, lower than expected inflation. The Fed might very well in that situation at some point decide why not lower interest rates and take some of the pressure off the deficit. They're not supposed to be concerned about fiscal policy, but it might be an issue. So along the way here, it looks to me as though there's certainly a case to be made for a strong stock market. And as you know, Lisa, I've been talking about 5,400 for the S&P 500 by the end of the year. And I'm kind of working it out. It might be by the end of next week, the way things are going. We're already at 5,300, and 5,400 looked pretty delusional about a year ago. Now I'm also talking about 6,000 on the S&P 500 in 2025 and 6,500 by 2026. And then I up the ante here, and I'm talking about 60,000 on the Dow by 2030 and 8,000 by 2030. So I've thrown a lot of numbers at you, hoping that you won't remember these numbers if they're wrong. And if they're right, I'll bring them to your attention.
You've been listening to The Forum by the Economic Club of New York, a nonprofit 501c3 dedicated to connecting the world's brightest minds for critical, nonpartisan conversations. Be sure to subscribe now to be alerted to future new episodes. Would you like to be a part of the conversation at the Economic Club of New York? Learn more about membership, the New York City and National Fellows programs, and other opportunities for engagement in the club at www.econclubny.org. I'm your host, Becky Quick. Thanks for listening.